Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC, member of SIPC. My co-host tonight is Pat Dunn. Good to see you again, Pat.
Good to see you.
Pat's with Merrill Lynch, also a member of SIPC. And our special guest, and this is a real treat, I love to work with Mark Mulholland, Matthew 25 Fund is our special guest.
Thanks, Charlie.
And good to see you again. Thanks for
Mark.
being here. We've had a lot of fun in the past. He's a great money manager. He's got great ideas. I like the way he thinks. It's going to be an interesting show. We just want to remind you, we're not attorneys. We're not accountants. We want you to check in with your own advisor before you make any decisions, but you might get some good ideas tonight, so stick with us. Okay, Mark, let's start off with you.
Okay.
So right now, price-earnings ratios are a little above normal from what I'm looking at. And do we deserve a higher multiple right now? Do you think stocks are a little overpriced? What's going on?
Well, the broad index is about 18.4, 18.5 times this year's earnings, and it is high. So I'm not always like this. For people who are family and friends, they ask me, I'll say, this is not the time to index. This is the time to pick stocks. So if you're dealing with a broker or have your own account, there's great buys out there, but it's not in the broad market. Now, on the flip side, I don't see a lot of things terribly overpriced, like in 2000 or other periods, like where you're worried about excess. So things are fairly priced; they're up there, but there are some great buys out there.
Can you talk to us about some of the sectors? Because it's been really interesting. Automobile sales are way up, yet auto stocks are not moving. Price of gasoline is down. People, normally when you save $28 at the pump, you spend $45. That's not happening. But other areas are doing quite well, like energy is starting to come back.
Well, it's come back from being hammered and stuff like that. I'm not a big top-down person, so it's not the right question. It's not the type of thing. I don't own any auto stocks. I don't like the industry generally, mostly just because if you look at it, any auto stocks, they're buy and sell stocks. You're going to have to buy them, pick a point to sell them, and so forth. Now saying that, outside of American stocks, I do know there's a couple that do show potential for high growth. Tata Motors, I do not own that, but I have owned it in the past, and I wouldn't be against buying that and so forth. The other part that you had talked about the energy, there's no question. In fact, I've never seen anything like this. I mean, I think I was on the show a year ago, and I really thought the basically tax cut that everyone got on energy pricing was going to be windfall for consumers, retail, and it hasn't happened. So once again, that's why I don't try to spend a lot of time on top down. But the market on broad is expensive, but I can tell you can find some great companies. In my shareholder letter, which is public, it's filed, so I can talk about them. I had written down. I actually went over four stocks that we own, and they're all big holdings. Goldman Sachs, FedEx, Boardwalk Pipeline, and Scripps Networks. Are all selling for close to half their value, what I think, in 4 to 5 years out, and nice dividend yields somewhere between 1% to 2.5%, and you can make a lot of money right now.
Yes.
Well, that brings up this. You said you're not a top-down guy, but still, utilities. Investors all over the world have wanted to come to the U.S. They wanted quote safe stocks. They've driven them up. You said PEs are around 18, but in some cases, toilet paper companies and Kleenex companies and soap companies are trading at 25 times earnings. And so those scare me a little bit.
I would agree with you on that.
Okay, and yet if you look in some other sectors like, technology, energy, you can find some PEs that are below that 18. So I know you're not a top-down guy, but are you hunting in those areas where the PEs are lower?
Yeah, sometimes I can tell you where I'm finding what I see as cheap. Financials are great buys. Goldman Sachs, for example, is selling for about 90% of tangible book value. Like, in other words, they can close up their business, shut their doors, not sell any other, they have a lot of divisions that would sell at a premium or what I call non-book value business, like money management business, but they could liquidate for 10% above what the stock's selling for right now. So, I think that is a screaming buy. Conservatively, I put the fair price in 4 years at 388 and selling in the mid 150s right now. Another area besides finance, and that's just one. There's other great buys in there. The energy, I keep looking. I do think there's great potential there. The only energy holding I have right now is Boardwalk Pipeline, which is in the pipeline business, which has a little bit less competition. I always worry about if you're in a pure commodity play, that you would, it's tough to really compete because you're so affected by the macro. And but Boardwalk Pipeline is still selling below book value. Its replacement cost is probably about 50% above where the stock is selling, and they have some great projects coming on to start bringing some of the gas from Marcellus Shale down to the Gulf of Mexico for the LNG and certain utility plants and so forth. So I would say that's another good area. I agree with you on consumer stocks. No discount. In fact, I used to own Smuckers, and we sold that just because it got to 12.5 times EBITDA, and that's 12 times EBITDA is the stopping price for Buffett on some of his consumer product companies that they bought into. So they're around. That's why I said there's groups that are fairly priced, and then there's certain stocks that are just giving them away. So.
Okay.
Well, now, clearly it is a stock picker's market, not an index market. But what about things like mid caps? What do you feel about the mid caps? Because the large caps have been run up. Yeah,
once again, I'm not great on that.
Okay.
Okay. Of the 4 stocks that I focused on, 2 are large cap, 2 are mid cap. So it's not. I don't work my way down. I don't wake up and think ooh, where you find buys. I'm still finding some great buys in the
So
mid,
you
in the
find
large
a
cap.
bargain, and then you say, "Oh, it happens to be a mid cap."
Yeah,
Right.
I always
Okay.
tell people I'm at least agnostic on caps, and I'm probably more of an atheist on caps. I don't care.
Okay.
If I can find a company that's at the right price, our fund, we used to be. That's one thing about Morningstar is deficient. They don't have a category for multi-cap, which is what our fund is, and so they're always jockeying around trying to classify us. But up until about 2007, 2008, we were probably more mid-cap. After that correction, we had a lot of large cap, but I'm still finding buys on large cap. So.
Okay.
Do you care whether the Fed raises rates or not? Is that the kind of stuff you look at, or are you just
No,
sitting
I
there
don't
looking
get
at your stocks?
I think they should raise rates. I
Yeah,
just don't know.
right.
I mean, everyone, and not that it's another show, Kramer, he always talks about it's like a death bell. And here's one of the things I look at. One of the few economist stats that I check at least monthly is I always look at the spread between TIPS, which are Treasury inflation securities, and regular notes. And to me, that's the best measure of what the market's telling you inflation. And right now, the 5-year projected inflation rate is 1.6, 1.59. Well,
Wow.
at 1.59, 10-year treasuries right now are 1.7. I'm not sure where 5 years are. They're probably, in that 1.5 range. They should be about 2.2 to about 2.7.
Yeah.
So,
And if the signs now of wage increase are starting to happen, and that can happen very quickly to adjust back up to where they belong once people realize that somebody's willing to leave this job to get a better paying job somewhere else, and once wages start to creep up, right?
Oh, yeah. Well, here's what's crazy, too. When the government was doing their monetary policy, the only break we got from the government the last 8 years was early on we got a little bit of a stimulus spending that, was a one-and-done thing. That's like a tax rebate. It doesn't really do it. The only prolonged support we've gotten has been monetary policy. So, Bernanke, did a wonderful job. Yellen's maintained it, and I guess they're struggling. But the thing that makes me laugh is all these experts on these TV, who come on CNBC and so forth, are telling you how bad it was going to be that they lower rates so much. And it was going to be so inflationary. It turned out not to be inflationary, and those same people now are saying how bad it would be to raise rates. So I don't get it.
Yeah.
I think they should be a little bit higher. I think basically trailing CPI is about 1.2. Short-term rate should be 1.5. Mid-term rate should be 2.5. To me, it seems pretty cut and dry.
Okay, well, let's take a quick pause on our discussion with you. I want to get some questions to Pat, but I also want to remind our viewers and listeners, don't market time any of these stocks we're talking about. The show is aired different times, different places. Pat, I know you like annuities for certain of your clients. Talk a little bit about why you like them in those certain instances.
Annuities are an interesting animal. It's something I get a lot of questions about on a regular basis. They are not for everyone. Annuities are best positioned for people trying to save to produce a cash flow in retirement.
Okay.
It's really an alternative to a pension because we don't have pensions anymore. Oftentimes people come to me and say, I was recommended to buy an annuity and my goal is to be able to pass money on to my children. I don't need my portfolio. Well, in that case, an annuity is absolutely the wrong choice.
Sure.
Because annuities don't transfer well at death.
Yeah.
So annuities are really meant for a living benefit, not a death benefit.
Okay, good answer. And we can't cover the whole area in a few minutes here, but I also wanted to discuss second to die insurance. a lot of people think about life insurance, but there's some extra or reduction in cost type of benefits if people get second to die.
People get second to die if they have an estate worth over $10 million.
Okay.
It used to be more popular when the federal exemption was a lot lower, but now that the federal exemption is in excess of $5 million, there's really much less demand for second to die. But it is a great estate preservation tool for your larger estates.
A lot of people don't realize, and I'm not an accountant and I'm not a lawyer that advises people on estates, but generally speaking, it's 10 that can be protected. The reason that you mentioned that number is if one spouse survives another, the spouse that passed away, that 5 can be passed over.
Correct.
So that 10 can go from the second person to die. So that's why you mentioned above 10 is where it's a fertile area for the second to die insurance.
Exactly.
Okay. And do you find that people are interested in this, that they get excited about it when you bring it up to them, if they're, the high net worth types that are above that area?
Oh yes, because they're looking to preserve their wealth. These are clients that are very much into legacy. We were put here for a reason. We were blessed with being able to save X number of dollars, and we want it to go to our family.
Sure.
Or to the charities of our choice. So it's people that are legacy minded are very interested in second to die.
Okay, one other area I want to explore, long-term care insurance. It seems to me from, when I take my continuing education courses, that there's a sweet spot for this type of thing, that people who have a great deal of wealth don't need it, and people who have a lesser amount where they're just living paycheck to paycheck can't afford it. So it's probably an area for people in between those two levels to consider.
Absolutely. I tell people if you have a portfolio worth less than $1 million, don't bother looking at long-term care insurance because the premiums are quite frankly going to be too expensive. The sweet spot for long-term care insurance are for those with portfolios between, or net worth really, between $1 million and $5 million. That's the area where a catastrophic life event could really upset the apple cart. And long-term care insurance fills a need. It gives a tremendous benefit if needed, and it also gives estate protection. And over $5 million, typically people have enough assets to self-insure.
Great, thanks. Well, while you're on a roll giving some good answers, let's see if we can help Jerry Holden of Newtown Square. Will the SEC and FINRA be likely to harmonize their rulings in regards to personal accounts to match the Department of Labor's regulations concerning retirement accounts?
Jerry, that is a very insightful question, and clearly you are an astute investor to be aware of this. But the answer to your question is absolutely yes. The SEC and FINRA are expected to harmonize their rules. It's expected to come as early as 2017 because it makes no sense to have one set of rules for retirement accounts and another set of rules for personal accounts. But at the end of the day, what this is all about, and it doesn't take effect until 2018, and there's been quite a bit of pushback against the Department of Labor for these regulations, so stay tuned, there's more to come. But we at Merrill Lynch, and I'm sure you at Wells Fargo as well, are very pleased to see this change, because what this change does is it raises the standard. It raises the standard to making investments that are in the best interest of the client, that is, that matches the client's goals and objectives, versus the old standard, which has been around as long as you and I have been in the business, so it's over 40 or 50 years old, and that was that recommendations had to be suitable to the client's risk tolerance. So we're raising the bar, and I think it is good for the clients, and it's good for our profession.
Well, after you and I have spent decades trying to do the right thing for our clients, putting them first, I'm glad to see that they're finally recognizing that that's the right thing to do. Exactly. And just so people know, the Department of Labor is involved in this because they have a need to replace pensions if if the money goes away due to bankruptcies and all that sort of thing. And so what they're trying to do is set some rules to make sure that there's less risk that these pensions will disappear. And of course, pensions are disappearing all by themselves now anyway, but there's still a few pensions out there, and that's the only reason the Department of Labor could get involved in this. But ERISA is hard at work to make sure that they're telling financial advisors to do the right thing and mutual fund managers to do the right thing.
Yeah, it doesn't really affect us, though.
Yeah.
Like, I see stuff. Well,
that's because you're doing the right thing.
Well, no, it's not
and we could get into a big discussion
because I run
about
a
that.
no-load fund. There's nothing. It gets into more like the cost of things and stuff like that. I do think when you talk about pensions, when Pat was talking about annuities, I don't deal with them. Obviously, I don't really know much about them. But when you were talking about that, where people want it for retirement income, my first thought was, who has pensions anymore? Nobody has pensions,
Right.
and there's probably
And let me
some
take a
demand for
minute
it.
to get the information up. If other viewers and listeners want to send in a question.
Sure.
Here it is.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
I think our viewers and listeners will really be interested in this segment of the show because we want to, you're a smart guy, you know how to pick the right stocks. We want to hear how you do that, how you think about it. You mentioned 4 stocks you like. Could you take 1 or 2 stocks and just talk about why you like them so much as opposed to something else?
Well, you're always doing stock picking to make money.
Yeah.
Go back to basics. And you can make money on really 3 ways. It's either growth, momentum, or value, or really what I should say, a price that's discount to value. I happen to be a value-based person, but our fund is set up, which ties into this, is what they call blend. Blend, really, I find the things that make the most money over time is when you can get growth at a reasonable price.
GARP.
GARP is exactly what in the industry, the acronym for it. The thing that I caught something, there was a great interview yesterday, not to date ourselves again, but it was the Goldman Sachs had done their, they do this 10,000 small business program. They brought Warren Buffett in to speak. And I watched most of the talk, and it was wonderful. And it was very interesting. He kept telling one thing, his advice to any small business person is to have your customer so happy with your product or service, like just deliver beyond expectations. And he used Amazon as an example. And a buddy of mine who runs a hedge fund, we were talking about that today. It's very interesting because he was so effusive about Amazon, yet he doesn't own 1 share.
Wow.
And what reason for that is a whole classic thing is a lot of times when you watch like a lot of these programs or when clients will like ask about a stock, they focus just on the qualitative. And I can tell you right now, I think Amazon's an amazing business, but it's expensive. I think Tesla is run by one of the greatest minds that we've had since Steve Jobs, but it's expensive. It doesn't mean so what happens is I would love to own them. I almost want a great bear market again because in the last bear market we were able to get Apple and Google and some other great companies. Facebook's another one I would love to own. It's just not in the right price thing.
Well, let me get a little better prepared for the bear market before it comes.
Exactly.
Well, it's not coming. But I don't think it's coming. There was a great indicator. People who want an economic thing to look at, and it's all government published. Look at the LEI, leading economic indicators. Year to date, without dating it again, the leading economic indicators are positive. The coincident indicators are positive. The lagging are positive. They've been positive or 0 the whole year. And I'm telling you, it doesn't break when it does that. And people are running around, they're wringing their hands because of what you brought up earlier about the market is up there in price. And yes, if you just look at the market, and if I was just an index investor, I'd be nervous.
Okay.
But when you look at companies, and this is what you go down, we'll take one of the stocks in there, not to harp on it, but I only mention it. And all this is written out in detail in my annual report, which is all filed with the SEC if anybody wants to read it. But like Goldman Sachs right now has a $169 tangible book value, has a $175 book value price. If they grow book value at roughly 7.5%, which is way below what they've grown at the last 10 years at 11%, if they can earn 12.5% on capital, which is way below the 17.2 what they've earned on capital on average the last 10 years, that company, and it just went to a 13 PE ratio, would be a $388 price in 4 years. Now, that's not a high growth company, but that's going to grow at least with the economy or slightly better. You can get it so cheap. So in my mind, in fact, I bought some shares today in the fund. If anything that pulls back, I don't have to worry about the downside. I know I'm buying it so far below what the long-term loss of capital could be. And I get this great company. Some people bash when I say Goldman Sachs, but you can't deny it's one of the premier investment companies, investment banks, and technically it's treated like a regular bank here, but it's one of the best in the world. It's got a great brand. It's put people all over the world in government and stuff like this. And you can buy that below its liquidating value. It just seems crazy to me. So in fact, Goldman had an analyst who got on and just said something like, pull out of the market or lower equities or something like that. And I was joking with a friend of mine who runs money, and we were just like, I go, really? I could picture the senior guys who have a ton of money in Goldman stock. In fact, Blankfein, who's the head, has $500 million worth of the stock that's even restricted from sale. And they're probably giggling because it's probably some young, recent Harvard MBA grad who's giving you this like big picture thing. And we're thinking, we really should say, sell all your index funds and put it all in the Goldman Sachs, and you have a chance to double or triple your money in the next 5 years. So, but, that's how people talk. So.
It is how people talk. And but what is, Mark, is your sell discipline? Because you definitely can pick stocks.
Yeah, no, we
when
sell
do you
stuff.
sell them?
Yeah,
What's their criteria?
Well, you sell really there's really 4 reasons to sell. The most obvious one, you need money for something. You have a redemption, you need some. So at any time in a portfolio, you have your list. I have stocks, like I have 16 stocks right now, and there's probably 10 that I won't sell until someone beats me over the head with a club. And there's a 3 or 4 at the bottom that I really like, but if I need money, I'll sell it. That same list, so it's kind of like, you have your or triple A, your double A, your A. I don't have a lot of B's or C's right now because I think there's some great values. But then also on that bottom list, when you find something better, one of the things you always do in market, I always tell people, they say research. I think it's search and research. You're always looking for new ideas, and you always want to research what you have. I spend more time searching, looking for new ideas, than old ones. Now, when you look for new ideas, it gives you 2 things. One, it makes you more confident that what you own is good, because I can't find something better. Or if I find something better, the bottom stock comes off and it goes into that stock. A good example in the last, and I'll sell things. Our turnover average is around 20%. So I hold things on average 5 years. But so it's not going to change weekly. But this year I made a conscious effort starting late last year and this year to buy the home builders. That I meant to get into that when you're talking about sectors. They are screaming buys. I mean, we're going into a housing crisis right now, but not the housing crisis that people still rings a bell in their head like, there was too many houses. There's not enough. And they're going to be, there's demand's going to go up. All these millennials that they're talking about living home, they're going to need housing.
They're now in year 7 and they're hitting 27, and mom and dad are saying, get out of the basement.
That's right.
We're not covering your insurance. They're
going to do it. And it's just crazy. And you can buy these home builders right now, a lot of times at 2.5, 3.5 times EBITDA. It's crazy.
Yeah.
With no leverage, virtually no leverage. So
I want to explore a little bit more on Goldman Sachs.
Sure.
So I noticed you said you're not assuming it'll go back to its previous glory, but you're just saying it's cheap from here. The counter argument you'll get from people is say, well, either Trump or Clinton, they're all going to insist that banks can't make money anymore. They can't have a little group over on the side that's betting on the red, And so everybody's really nervous that whoever's going to get elected, and certainly the amount of regulations in the past 7 years have been onerous, so that's the fear that's holding it down, right?
Yep, I'll answer too. The regulation is going to, I believe we're at the peak. But I'll also tell you this, in any industry things change, and in the financial industry things have changed. But the financial stocks, Goldman Sachs or any financial stock, is really made up of only 2 things, people and money. They're the easiest things to change. There's no big infrastructure. There's no big plant and equipment. There's some changes. Like I think you'll see less branches out, like for true commercial consumer type of lending and stuff like that. Goldman's not in that. But the easiest thing to change is people and money. And Goldman will adjust. And they've been adjusting all along. In fact, there's been, they acquired a fairly big lending operation from General Electric, and they're going to, you'll see them look a little bit more like a bank, because I guess they're assuming they can make more money into that. There'll be less bond trading, because bonds aren't that great, but they will adjust. But when you can get something, a great company like that, that's below its liquidating value, I don't know when it'll kick in, and I always look 3 to 5 years out, and I always talk about potential. The potential is so high. The risk is so low. The other part of risk, any financial stock, your risk is always the leverage risk. They probably would average somewhere around 4 to 6% equity to assets. So you're really looking at somewhere between 20 to 15 leverage. They're at 10 times leverage right now. They're more conservatively set up than they've been in the last 25 years, even in years as a partnership when they had some filings on that. So it might not work.
Yeah.
This is not a treasury bill, but the return potential to the risk are so much in your favor, and that's really what I look for all the time, and they are out there today.
Yeah,
and you don't have to just index.
And even a smart guy like you has to agree that past performance doesn't guarantee future results. So
no, we have to say that, but sure it does. If I was going to judge anything, I'm going to look at past performance
sure,
first.
Sure, it's the best way you can guess.
That's
Absolutely.
right.
We got a couple of minutes left. You got another question?
Okay.
I'm just wondering, the last thing I was thinking about is, what do you do about cash levels? You want to have some money in case the stock drops, but you also want to be invested. How do you handle your normal cash level?
Right. That's where I'm a dumb person. Because, and this is what happens. I am when I find something I really like and they adjust, I'll give you another example. One of our biggest holdings is Polaris. And just yesterday, for no reason, because the stock ended up positive, at one point during the day it was down 4%. I can't help myself to buy. So I even think about that, like where Buffett sits with a lot of cash. I wish I could do that sometime. I just can't do it if I can find things to buy. And it's the same way on myself. I just, if personally, I try to keep cash. There's a level my wife won't let me go below. But on any of these days, they're correct. And the one thing the market always gives you is volatility. And I look at volatility as opportunity.
Mm-hmm. Yeah, well, you have to have enough cash. When the guy wants to buy a boat, you can send some money out to him, right? So
well, when you say that, here I'm telling you I keep cash. I do I try to keep about 1%. So our fund right now is about $400 million. I have $4 million in cash, which seems like a lot, but it's pretty easy, to spend $500,000 if a stock corrects and stuff like that. So I strive to keep cash. I can tell you I rarely ever keep more than 1%, and I know there are funds that do much more, but I wish I was better at that.
All right. Well, I want you to take 1 minute to tell people, how did you first get interested in this? What was the path to your success now?
I followed Warren Buffett. Warren Buffett started out as a stockbroker. Then he went back to school, ended up working for, owned a partnership with Ben Graham, then went on his own. And to me, and then he eventually bought private companies. So I think I'm only going as far as the mutual fund, which was a way to run money for multiple people. I also thought about it. I made a choice. Like, I'm 56 right now. I hope God willing, I'll be working at 86. And as long as there's two other people, I'm going to keep the fund open or form a partnership. And I'm going to manage my money. That's how I treat the fund, like it's my own account.
You eat your own cooking, I know
that.
Oh,
completely. My wife and I are the largest shareholders, and I will run this as long as there's at least a couple other people who want to stay with me. And when they stop, then I'll manage my own money like a greedy capitalist.
Well, be careful crossing the street. We want to do a lot more shows with you.
Yes,
thanks,
yes.
And I really appreciate both of you being in here. It's been a really fun show. I always enjoy seeing you come in, and I hope you'll come back again soon.
Thank you, Charlie. Sure.
Okay, well, next week, our guest is going to be Rob Doble, Adherent Healthcare, and I think we're in a need to find out about what's going on in healthcare right now with an election coming up and all the different turmoil that's going on. Maybe Rob can give us some insight. So stick with us next week. As far as we're concerned, your money matters.